Hello, and welcome to UCI Beal Applied Innovations VC Speaker Series, our webinar featuring conversations with VCs and investors. Our goal for this webinar series is to continue to connect the Southern California innovation ecosystem with the experts and resources that will help entrepreneurs and founders navigate the current crisis and thrive in the recovery that we know all is coming. For today's webinar, we're honored to have Saurabh Suri, who is the managing partner and CIO at CerraCap Ventures. Before we begin though, I'd like to acknowledge and thank our sponsor for the VC Speaker Series, Kenobi Martins. They're consistently ranked as one of the top intellectual property firms in the nation and worldwide. Kenobi Martins has close to 275 lawyers and scientists and dedicates its practice to all aspects of intellectual property and technology law, including litigation. The firm's headquartered here in Orange County, actually, and we're very fortunate at UCI Beal Applied Innovation to have Kenobi as a strong supporter of our mission and the mission of the VC Speaker Series. So you can get more information about the firm at www.kenobi.com. So right now, a few details about the webinar today. Many of you have come back, so I appreciate you continuing to tune in. So you know that unlike many Zoom meetings that you've been on in the last 4 months now, you can't unmute yourself on this one and you can't turn on your video. But if you have a question, please type it into the Q&A box, not the chat box. So I'll moderate and ask those questions throughout the discussion or right at the end of the discussion. And a reminder that this presentation is being recorded. By next Monday, you can visit UCI Beal Applied Innovations website at innovation.uci.edu to rewatch the webinar or view any parts of it. Finally, next week on Friday, July 24th, we're gonna have another VC speaker series. So we're doing 2 in a row. This one's gonna be with Tracy Rotter from GV Ventures. So some of you may know GV Ventures is owned by Alphabet, which is a parent company of Google. So they're now GV Ventures. Watch your emails for more information and the link to register for that webinar. We're actually going to put the link in the chat box near the end of this event. So with that, Saurabh, I'd like to see if you could join us here. And oh, there you are. Terrific. So welcome. I'm so glad that we were finally able to get our schedules aligned and to get you guys, one of you from CerraCap, here on this program. I know you guys are a global investor, as I've said to a few people, but you're somewhat under the radar here in Orange County. So I'm glad that we're going to help get the word out a little bit. So I think I wanted to start off as I kind of wrote in our notes that you're your managing partner and CIO. So I'm saying, well, my boss, Richard Sudek, is the chief innovation officer. You guys sell to a lot of chief information officers, and a lot of firms have chief investment officers. So which one are you?
Well, first of all, good morning. And Luis, thanks so much for having me on here. We're really big fans of what you're doing for entrepreneurs and pretty much the OC ecosystem. And you're right, we have been a bit guilty of running around the globe, but not looking at our own backyard, cool. Myopic to a certain extent. But to answer your question, frankly, if you ask my colleagues, they prefer the moniker of chief irritant or chief irritant officer. But because of our slightly different model that we work in, I sometimes play the role of investment oversight and sometimes on information advisory, and frankly mess them both up. Fortunately, I have the right partners to cover for me.
Good, good. Well, I think right now you're probably not traveling, so you wouldn't be the chief itinerant officer, which would be another good one you can use for who's ever out there the most. So listen, there's a lot of great, very interesting things to talk about with CerraCap. But before we do, I'd like people to kind of get to know you a little bit more and understand your background. So can you tell our audience a little bit about your own personal history?
So I think the best way to describe my background, Luis, is discombobulated. Right. I spent my formative years back in India and had my schooling there and kind of all over the place in Southeast Asia as well, and did a part of my research in England. in what was then called neurocomputation and cybernetics. Now you call it AI, deep learning, whatever. So essentially, I'm a card-carrying member of the Nerd Society.
Got it.
And then across pretty much my education and personal life, lived across 4 continents, about 9 countries, if I remember. And the prevalent joke was nobody could stand me for too long, so passed me off. I started off in technology and frankly in deep tech, or what was at that time deep tech. And then later on made the conscious decision to move from the technology business to the business of technology.
Okay. So, so from there, you, I understand you were also an entrepreneur yourself, right?
Yes, in my early and mid 20s, sold my company for what would then be called beer money. But yeah, following my studies and research, I worked across Europe, India, and the US. Even had my startup for a bit. I then joined a firm called UST Global right here in Orange County, and worked with them for over 15 years. And was very fortunate to be a part of their phenomenal growth story, from a few million to a multi-billion-dollar organization that they are right now. And it's pretty much there that I made that switch, from being a technology architect, coder, et cetera, and then moved to running sales, operations, and finally investments.
Okay, so yeah, you managed the corporate VC at UST Global, is that right?
That is correct, across their corporate venture investments primarily.
Got it. And so tell me about what motivated you to, you and your peers actually from UST Global to decide to kind of break off and start a venture capital firm. Hopefully it was more than just the money, I'm sure it was.
For sure. It was, I mean, both. For me, as well as for all of my partners, we love the concept of building in itself. And USD Global has become this amazing, huge, giant corporation. And then, you have that discussion of, okay, should we start another company? And then, you have the Austin Powers moment. It's like, why have one company when you can have 100 companies? But no, in all honesty, the really short answer for that is, we saw the definition of value, right? So running and working at UST and running investments there, we worked across technology companies, VCs, et cetera, and saw how VCs at all stages, how other firms defined value. And we understood that we approached that very differently. So the way we define value is actually driving sales and purchase orders and helping startups scale. And we ran this model with quite a lot of success back there. And it was at that point that my then boss, who was the CEO over there, came up with an amazing and frankly crazy idea at the time, right? Which sort of led to what we are today. And the thought being that if you want to invest in companies that think differently, you have to be an investor that does things differently. And that was the genesis and the thought of the idea, which kind of made us make the plunge, as it were.
Yeah, that's terrific. I really like the framework that you and I discussed about CerraCap in terms of the kind of what you do and how you do it. So I think that was a great framework to think about it. So and I love the phrases that you guys have come up with. So why don't we launch into the kind of the what you do at CerraCap?
Right, absolutely, and frankly, a quick shout out to my chief marketing officer, Nikki, if she's around, who kind of constructed this so beautifully for us. It was more a stream of consciousness that she formulated so well. But what we do is we industrialize innovation. What does that mean, right? We take innovation or an idea and the right kind of vision and help it scale to global proportions. Hence the industrialized innovation, right? And the whole thought behind it is to enable impact at a global level, as opposed to keep an idea in your bathtub, right? So that is our entire drive, to industrialize innovation, is what we do. How we do it is a very specific model that we formed, what we call the sales and scale model. And the idea is we actually take a company at a very early stage, sometimes pre-revenue, early revenue. And once we invest in that company, we actually help drive purchase orders into that company, right? And there's a huge difference between making introductions and driving purchase orders, right?
Okay, yeah, tell us about that. How does that, what is the difference? Because I think a lot of people would say, sure, I'll make a warm introduction for you and wanted to give them a call, or I think you should try to pitch this company for your software. So how do you guys drive the purchase order itself?
Precisely. So when you talk about an introduction, I don't want to knock it. I run around. I live and breathe for introductions. So
Chief Introduction Officer. There you go.
I love that. Right? Absolutely. I could have used that one, but
okay, I'm going to use it too.
Yeah. The way we look at it is you can have warm introductions into CIOs. And when I use the word CIO here, it'll refer to chief information officers, right? In Fortune 500, Global 1000 client bases. One is a warm introduction. You go up to a chief information officer, he likes it, he puts it down to his peers, you then pitch, you do the whole POC, then you got to deal with the procurement guys. So there's some, and this is called the sales cycle, right? For us, a warm introduction is only the first step of a sales cycle. Whereas a purchase order goes through the entire supply chain till you actually get a signature, right? And this comes with our background with UST Global, me and my partners, and very specifically, my partners have, I think over $500 million in enterprise sales experience under their belt. So they come with that understanding and that thought process of that difference between an introduction and a purchase order. So you go into an organization, it's not just that we know, let's say the CEO or the CIO, but also the guy in procurement that nobody really knows, but he's the guy who signs the check. So how do you run that sales cycle and run it efficiently, right? So for example, an early stage startup, 6 guys and gals and a dog, trying to approach a Fortune 500 company, they'll have an 18-month sales cycle if they're lucky, right? How do you make that more efficient? How do you collapse that to a 6-month sales cycle or a 3-month sales cycle if you're really lucky, and go through that piece? So that's the aspect of sales. Get in, drive purchase orders, and across our portfolio companies, I think at least their first 4 or 5 marquee clients tend to come through us. And then also drive scale, right? And this is something I tell a lot of my portfolio CEOs is that, hey, we'll help you get a Costco or a Wells Fargo or a Bank of America as a client tomorrow, but what happens the day after? The amount that you have to scale to meet the demands of these clients is through the roof, right? And it's not just high-end technology talent that you need. It's also the middle and low-end support talent that you need. Right. And with our experience in services and scales, et cetera, we help drive that sustainability almost, and putting that company on the path to greater growth and success. So that's the whole model of industrializing innovation, but through specifically sales and scale.
So when you're working with portfolio companies, I assume then, a lot of investors say we're very active investors. So it sounds like you're kind of take active to a kind of a different level. I mean, you're communicating weekly, daily with some of these portfolio companies, and are you participating in their sales pipeline discussions, for example? Or are you going through are there regular cadence to how they're doing on their sales side?
Absolutely, but I'll throw in a caveat there, right? Which is initially, yes, we're extremely hands-on, but if we do our job right, over the years, that amount of involvement fades. And that's what CEOs also want investors off their back at some point in time, right? So going in, we want to make sure we help set up that sales model in the right way, get in the right sales talent if they need it. Help them grow that piece so that we can start taking the step back as well. That's number one. Number two, absolutely, our involvement with the companies is through the roof, right? And hence, as an early stage investor, we actually have a little more, I wouldn't say a little more concentrated portfolio than normal, let's say, early stage investor VCs. And because the way we do our risk mitigation is different, right? Normal early stage approach is you do your risk mitigation by correctly spreading the dollar across, right? We do our risk mitigation by actually driving revenue into companies. Hence, we look at smaller portfolios, greater involvement into those portfolios, and then growth from there.
Got it. So, I think just to be sure our audience also kind of understands, can you give us a little bit closer look at the types of companies then that you are looking at that fit into this model? And specifically, how much traction or revenue do most of the portfolio companies have before they get an investment from CerraCap?
So I'll talk a little bit about stage and sector and go into that. So in terms of stage, we are early stage VCs, right? So we look at anything from a seed stage to a Series A. Sometimes depending on the company, and we're a little bit flexible on that because we look at companies and outcomes more than anything else. If it's a little beyond Series A, but in the right frame, and we can really add that value to the company, I'll even look at post Series A like a convertible before a B, right? So that's this, let's say the stage we play at, that early stage investment. In terms of sectors, our focus is on areas around cybersecurity, AI, and health tech. And they're two very specific to B2B and B2E companies, so business to business and business to enterprise, right? Honestly, primarily because that's where we provide that value of the buying behaviors of the CIOs of the large corporations that we bring in, et cetera. So that's where we focus on. Then a level lower within those areas, because when you say things like cybersecurity, AI, and health tech, that's a huge universe, right? Yeah. We, again, further look at, so if you look at health tech, we won't go into bioinformatics or pharma or something of the sort, but technology-enabled, data-enabled, AI-enabled healthcare companies. And cybersecurity, there's certain segments we'll look at. We don't look at the hardware side of the world, primarily on the software base. So that's where our focus kind of lies. And one of our biggest, let's say, qualification criteria is also the value that we can provide to that company, right? Do I have the right ecosystem to drive that sales and scale into a company, right? So let's say you're an AI company, but you only sell to travel and hospitality or to a very specific niche market where I don't have an ecosystem. I can't drive that. Then even if you're the best company, I won't be able to provide that value. So that's an automatic filtration for me.
Good, good. How about the revenue levels of the companies then?
The revenue levels tend to be we do invest in pre-revenue companies as well, but you have to have, what we won't do is we won't invest in what we call slideware, right? So slideware is a couple of slides, nothing exists behind it. You have to have a proven product, right? And that proven product could be through, POCs or whatever else, something that we can put into these large enterprises and actually kick the tires to see if you can scale. Right. Yeah. And we're seeing this, and this is a very, very positive move that we're seeing, that more and more companies, even earlier and earlier on as they go to raise money, already have that product, the product roadmap and vision in place, as opposed to primarily having a slideware and an idea. And again, let me be clear, I'm not dishing slideware, that's the best way. And you have accelerators and incubators that really do that piece and approach it from there. But our value comes in a little beyond that. So I wouldn't put revenue as the biggest delineator for us, but the existence of the product, the idea, and the roadmap being of larger importance to us.
Right. So it sounds like somewhere, certainly minimum viable product at least, and probably a little bit more advanced. I think what I like about what you said, some entrepreneurs and founders, rightly so, focus very much on MVP. But what I like that you pointed out, you said it every single time, it wasn't just product, but it was roadmap. So, what they have, but, some sense of the roadmap of where they need to go to get it there.
Precisely. And as early stage investors, and I'll say this for my other colleagues in the industry as well, right? To a certain extent, we invest in not just what you have right now, but your vision and your ability to execute against that vision as well. Because we're early stage investors, we're the journey guys. So you have to have that vision, you have to have that vision in place, and that forward-looking piece where we will kind of look and grow with you, as opposed to, hey, this is what I have and this is it.
Okay. So I mentioned earlier in the description, and it's accurate, I believe, you're definitely a global investor. You guys have investments all over the place. So how do you source those deals? Where are some of the ways? You probably can't say a blanket, here's how every deal gets to us, but how are some of the ways that deals have gotten to you guys for the investments that you've made?
Right. So again, and this comes from our background and viewpoint, right? So we're looking at companies that make a difference and make an impact, right? Silicon Valley, both fortunately and unfortunately, is not the only place anymore, right? You have these hotbeds of innovation globally. If you look at the kind of cybersecurity companies coming out of both Israel and even Europe, you look at AI companies coming out of Singapore, etc. Right? So yeah, we have a very global focus. We look at these hotbeds of innovation and look at some of the best companies coming out of there, and then bring them into the fold and help them grow here in the US. Right. I'll give you an example. Deep Instinct, it comes out of the Mossad and the intelligence units of Israel. Mm-hmm. And it is one of the most differentiated company, and actually one of the first companies that use deep learning in endpoint and malware detection. Right. Okay. We invested them at an early stage. They've done phenomenal. Just closed, I think, $120 million contract with HP Computers recently, and this is just in a span of about 4 years that they've been able to grow. We also work with areas such as Los Alamos National Labs, right? So one of our portfolio companies, Biome, came out of there in the human microbiome space. Right now, in a matter of, and with a phenomenal CEO, Biome right now is the largest private database of the human microbiome in the world. It's working with companies such as Glaxo, et cetera, in vaccines. It's about to launch, I don't know if I'm letting too much of the cat out of the bag, but about to launch the world's first personalized nutrition and supplements based on individual microbiomes and the analytics that they've been able to do against it. Right here in our backyard, we've got a company, Nirveda, in the AI space, Nirveda Cognition, right here in LA and OC, that we help kind of seed and incubate, which is doing fabulous stuff in really the future of AI and AI enablement, and what they call the industrial 4.0 aspect. In fact, they recently just launched an amazing product called Alpha to help small companies and community banks with the PPP loans. And this was an immediate reaction to the whole coronavirus piece. And it's fabulous that, with the kind of ability and the AI platform that they have, that they could so quickly launch a product which is helping small businesses and community banks with PPP loans in a matter of months. So those are the kind of things we look at, and those are the kind of companies we look at to invest in and grow.
Right. No, that's a great short list there of those companies. I really appreciate the fact that the company was able to pivot quickly and produce something in response to what the financial industry needed. And there's probably a lot of solutions still that have to come out of that. So I did, looking through your portfolio, I also saw that one of your portfolio companies was acquired by RSA, the big security company. Can you tell us a little bit about that, and maybe what role CerraCap may or may not have played in that acquisition?
Absolutely, and we've been fortunate to have a few companies that we've helped and enabled to get acquired from our overall ecosystem, right? And when we look at this kind of route, now whenever you get into an acquisition, especially acquisition with big names, you have NDAs and all of that stuff playing in, but specifically, what we've seen is when larger companies look at acquisitions in themselves, they're looking at three things: expansion, talent, and edge, right? So if I'm a large company looking at a startup, can you help me expand beyond my existing customer base? Let's say I'm selling into a specific segment, but your complementary technology helps me expand that segment and brings in a couple of big name logos into it. Brilliant. Talent. This is interestingly becoming one of the key areas of acquisition, right? In fact, there's a whole industry around talent acquisition through companies, right? Where they actually put a price on the head per engineer that the companies have. And that's critical and very important. And then there's the edge. What is that complementary edge that you can provide? And of the companies, including the company we were able to sell into RSA and a few other areas, these are the three aspects that played the biggest role in terms of closing the deal, right? The ability to show that company how we can help you with expansion, how we can help you with talent, and what is that edge we can provide you. Everything else turns out to be noise if you can focus on those three aspects.
Yeah, it sounds like certainly from your experience, whether at UST Global, your team's experience is kind of have some investment banking insights there about what it takes to get those strategics interested. No, that's great. Expansion, talent, and edge. I jotted all three of those down. I like that real quick. We do have a question in the chat, which I'll throw out there since it's kind of foundational and we didn't touch on it. Can you give us a sense about the sizes of your funds and what is your typical check size?
So our typical, again, because our stage varies quite a bit, anywhere between seed to Series a little beyond Series A, our typical check sizes also vary. It's not a very large variance, but anywhere, our initial check sizes tend to be anywhere between $500,000 to $2 million. However, we actually reserve a lot more for follow-on rounds into companies. Again, and then the reason we can do that is because we have smaller portfolios that we work with. So our initial check sizes range anywhere between $500,000 to $2 million, depending on the stage, sector, etc. We syndicate a lot of rounds with other CVCs and other corporates that we bring in into the round, and then reserve a lot more money for follow-ons, kind of trying to put our money where our mouth is, if you would.
Yeah, that makes sense. I just switched.
My phone was dying. So
there you go.
Yeah, you hear me there. So sorry about that, everyone. But this way you can, maybe I sound a little bit different, but at least you can hear me. So I'd like to drill in a little bit on, once again, on the sales aspect, because for enterprise software and enterprise SaaS, I think there's so much that that entrepreneurs can learn. So I've got several questions, but why don't we just start at it from a business model perspective? So, you know, obviously the business models have changed in 15 years. That's no surprise to anybody, from big site licenses and annual maintenance contracts to software as a service, et cetera. But in the enterprise space, do you generally have any advice about which business models work best for enterprise software companies at what point in development, or perhaps sector, or perhaps the problem that they're trying to solve? So can you talk about business models? Then we'll talk about how you actually get those purchase orders.
Sure. Yeah, business models are very, very varied, depending, like you rightly said, based on the sector, based on the product type, based on the technology, significantly different, right? However, what we've seen, of course, SaaS models are so successful because of their ability to scale, because of their future cash flow probabilities, etc. Hugely successful. There's a very interesting trend we're seeing in the market, and we're trying to drive that more and more. In fact, I'm actually working with 2 universities to do a little more research, which is outcome-based models. Right? And we love outcome-based models. Right now, those models are highly risky, but the few companies that have been able to pull them off have been wildly successful. So first you have SaaS, right? Or rather, first at the start of it, you have, how do I charge my client? Okay, I don't know, $10 per endpoint. Right? Or $10 per mobile phone if I'm a mobile phone API. Then comes SaaS, which says, forget all of the hardware, don't care about it. I'm just going to click a ticker every time you touch my software. API, right? So every time you click the API. One example of SaaS. Again, I'm oversimplifying. There are about 50 different variations under that, but just to talk about the evolution. And going from that to outcome. I don't care about your endpoint. I also don't care about how many times you touch my software. What I care about is the outcome I drive for you. And you know what? I'm going to take a part of that. Now there, you have to focus on, what we call the CEO cross. Right? I love it. And we work with a lot of these fabulous engineers, right? But there's an old saying, I can either ask for a hydrogen oxygen compound in a silicon-based container, or I can ask for a glass of water, right? So when you approach in terms of, when you're pitching to a CEO or a CIO, you look at the CEO cross, right? Revenue, profitability, risk, and quality, okay? My software, whatever it does it impact any of those four? Or it has to, first of all, let's start from there. Second, how do I illustrate that aspect, right? So for a good SaaS sale, you have to illustrate, hey, I'll make your sales conversions, 30% more effective, basically driving your revenue. Or I make your profitability and your operations better, etc. right? Now from there, you move to that next model, which is that outcome-based model. By the way, and if I do that, I'm going to take 30% of the entire increase on your revenue. That's your outcome-based pricing. So you're basically, when you move from endpoint-based pricing to SaaS-based pricing to outcome-based pricing, you're making things a no-brainer. Now, don't get me wrong. It's really, really hard, and we've made the mistakes with outcome-based pricing, right? There are a lot of areas or a lot of hoops you have to jump through to be able to get to that. But if you can keep that holy grail in your mind and move the company towards that, that's where we see a lot of the new age and the new world in enterprise. And I also want to kind of be specific. Whatever I'm talking enterprise and B2B based. Any entrepreneurs who are focusing more on the consumer side, the direct B2C side, just tune me out for a bit because I might be leading you down, the wrong garden path, as it were. But yeah, in the enterprise space, that's how we see progression going in.
Interesting. No, I mean, certainly that model exists. There's a company here in Orange County that has made millions and millions and millions of dollars, on insurance claims, for example, or Medicare claims or something like that. You're billing this much. We can help you move from 88% to 92%. And by the way, we'll take that first 2%. You'll get it. So that outcome-based model certainly exists in other process-based areas. There's but from a software kind of looking at it from a software perspective versus a SaaS perspective, that's pretty interesting. I would love to I'd love to kind of stay in the loop in that and understand which are some of the companies that are successfully pulling that off. That would be pretty fascinating. All right, well, let's. Can you give us any examples? I'm just curious if you want to throw out an anecdote there about. In light of those models that we just talked about and the kind of the standard SaaS models, can you give us some examples where your firm has been instrumental in actually kind of getting that signature at the back end? I know that's certainly what you're trying to do. Any interesting stories that we might learn about?
Yeah, absolutely. In actually two of our cybersecurity companies. One of the interesting things we did was we have our own CIO council where we work with a lot of these CIOs, understand their CapEx and OpEx budgets, their spending patterns, etc. And many a times during the evaluation phase itself, we get them involved, right? Where there's almost a tacit question that, hey, if we invest in this, is this actually something that you will buy? Does this actually solve the problem that you have? Right? And involving a lot of these buyers, or prospective buyers, prospective buyers early on in the stage, and then working with both the company and the buyer to enable that has been very effective for us in driving those purchase orders, right? Several times we work with these CIOs to put these companies in, these quote unquote innovation labs as well. And every large company has an innovation lab. Many of them are like 5 guys sitting in a basement, sometimes twiddling their thumbs. So they love it when we throw new and cool stuff at them to play around with, right? But that's just the start of the journey, okay? Then we've actually worked with these companies in certain cases to help, shape or reshape their pricing models, but in other instances to help evolve their message, right? Because especially when you go into enterprise with a large enterprise space, you have to understand the mindset of the customer before you walk in. What is or how they define their problem. You may have that same problem exist across 10 companies, but in larger companies, and we've seen them, the way they define that problem is a little different. And if you can approach that, and that's where we work with the companies to shape that piece of how or what problem that they're trying to solve, which is the second piece. And then going in and working across the organization, not the startup, but the enterprise. Like I said, not just the CIO, but all the way down to procurement to help drive that change and drive the purchase orders into them. And those are really the stages that we look at initially, right? And while we're doing all of that, also making sure, and this is actually comes from a lesson learned, we made these mistakes early on, where we did all of that, but didn't help those startups actually develop that into their own process and expand their own sales teams to do it. So, which is a lot that we focus on now as well in driving this in.
Okay, that's you kind of answered one of my other questions, which are some of the mistakes they make, and it sounds like understanding the customer, being able to define the problem in the way that the enterprise or their customer kind of defines it. I think that's useful. Kind of in light of that a little bit, in terms of your startups or other advice to enterprise software startups, how much effort to put into proof of concept projects and pilot projects and versus paid projects? And sometimes it seems like startups spend all of their cycles chasing these POCs, and yet at the end of the POC they're left with maybe an engineer or someone on the customer side that said, yeah, that was cool.
I'm grinning ear to ear because I've faced that problem. Every one of my portfolios faced that problem. And I'm sure if there are any entrepreneurs out there listening to this, they've all faced that problem. That's the bane of startups, especially when you get into, or at least try and break in and get into scale, right? And I've seen some fabulous entrepreneurs approach this in various different ways, right? But I'll talk a little bit about the fundamentals in terms of what we've learned. And I underscore the word learned because, pardon my French, but I've screwed this up more than anybody I know, right?
Yep.
So we look at this in 2 ways. Number one, yes, as a startup, you do have to give up a pound of flesh, right? You do have to have that proof in the pudding, which gets defined as proof of concepts, et cetera, et cetera. But then the big question is, how far do you go? Okay, the 2 kind of metrics or rules of thumbs that we use. Number one, when looking at proof of concepts, define outcomes. Hey, Mr. Customer, I get it. Proof of concept, absolutely. I'll give you my pound of flesh. You want naming rights to my firstborn, maybe we'll put that in the negotiation. However, if I meet your metrics, and those metrics have to be very well defined, can we pre-sign on that revenue?
Ooh, okay.
Okay. Now, mostly I prefer paid. Go in for paid POCs. In some cases, especially with very, very early stage startups. Okay. They think that they have to do it. And you know what? I get it. I've done that as well. But make sure the outcomes are defined, right? So at least you have a light at the end of the tunnel, and that light is not an oncoming train.
Yep.
Second aspect, and this was actually taught to me by somebody, and I follow it to the T. Remember one thing, and this is true of proof of concepts, it's true of sales, and it's true of fundraising. The next best thing to a yes is a no. It's the maybes that will kill you. Okay? Most entrepreneurs waste time and cycles running after maybes. if you're more targeted and definitive around the way you're structuring your proof of concepts with the enterprise, how are you looking? And we work a lot with pretty much every single portfolio company of mine around this very problem. How do you structure that so we're not wasting time, right? Or so we don't have anything at the end. Now that outcome, what it is, depends on what stage you are, right? So if you're just out of an MVP, that outcome would be, can you be a referenceable customer for me? Or it could be, can I get that purchase order or whatever? But it has to have a defined outcome. Without that, don't go into a POC. I know that was a much longer answer than you were expecting, but you hit a nerve right there for all my portfolio CEOs.
I'm so glad I did. No, that was brilliant. That was brilliant. So, if I could recap appropriately, just so everyone kind of sees that I'm excited about this too, is that define that concept, that project as well as you can, as focused as you can, so that you can get to that stage where, if I could jump to the end, where you're eliminating a lot of the maybes. Understand, is it a yes or a no? Kind of eliminate those maybes a little bit to really focus on that. So that is terrific. Close enough? Okay.
Bang on.
All right, great. Listen, we've got a lot of questions already kind of backed up into the Q&A, and I still have a few more too. So here's what we're going to do, folks. For those of you that have asked the questions in the Q&A, I'm going to get to as many of as I can, but we are going to knock off a few more things here with Saurabh, and then we'll get to those. So as I'm kind of going through my areas here, I think you've touched on a lot of the good areas. So let's talk a little bit about just kind of what's going on in the world right now. So a lot of the VCs that we've spoken to in this VC speaker series over the last 4 months told us that that private company valuations definitely took a hit right at the beginning. And then as things have gone on, we've had some other folks that said, we're actually surprised or pleased that because of the quick reactions of some of the companies, because of PPP loans and EIDLs and some other things, that the cash crunch maybe wasn't there as extreme as it was. So what has CerraCap seen, and what do you think is kind of happening now in terms of how your company's valuations are dealing with it? And how's the sales pipeline for your portfolio companies looking right now?
So we've actually been quite fortunate because we're more enterprise focused as a fund. The impact to us was not as great. It was still great, but not as great as a lot of the funds that were, let's say, focused on travel and hospitality or focused on specific consumer segments, etc. Right? Having said that, yes, there's been an impact across the board, but it's been interesting how that impact has been in stages, right? And I've seen both me and a lot of my other GP colleagues who run funds have been reacting to this. So initially, most VCs, and again, just for the audience and to give context, I'm going to talk about the early stage of the market, right? So early stage companies, not delve into the later stages, pre-IPO or public markets, right? But most VCs spent, once we understood what was happening. First, it was a question of, wait, what's happening? Then you understand what's actually happening. A lot of VCs spent the time primarily with the portfolios and reserving money for those portfolios, okay? And helping these portfolios increase their ramp, right? Ramp is time to the next raise, how much money, cash you have in the bank, how much you can generate, et cetera, et cetera. Yep. That was part one, right? Runway, pretty much, right? Helping them extend those runways, ensuring that we have enough reserves to help those companies out. A lot of that from what we're seeing in the market has been done. And now a lot of VCs are now opening up and looking out for deployments rather aggressively, right? Having said that, then comes the second piece. And you talked about how does that sales really work right now. Mm-hmm. So the first thing we did was also rejig the pipeline of a lot of these companies, right? So which means, yes, in the enterprise world, sales cycles have become much longer right now, right? But interestingly, if you look at IT budgets have not been slashed at the level they were during the 2008 and even the dot-com bust. I mean, I remember during 2008, IT budgets were like completely decimated, enterprise IT budgets. That's not been the case. However, IT priorities have shifted quite a lot. And it's very important to understand the new IT priorities of a lot of these CIOs. So it is rejigging the sales pipeline. There were actually companies, if you look at companies, especially companies in supply chain, large companies in healthcare, et cetera, that are spending way more. Their CapEx budgets have gone through the roof in trying to meet the demand. So their IT budgets have actually gone up. So can you rejig your pipeline and focus on people whose IT budgets have gone up? So especially if you're, a horizontal solution like cybersecurity, you don't care if it's healthcare or supply chain or whatever else. So can you focus on that? Those that are sector specific, look at the guys and see how their IT budgets have evolved. So that was the second piece. And the third piece, and we too are in heavy deployment. Yes, valuations have taken a hit, but more than valuations taking a hit, the process in which that VCs use in evaluating the companies have also evolved quite a bit. So now there was a really, really big aspect that a lot of VCs did not have in the due diligence process that now do, and that's resiliency. Okay. And it's that resiliency also has a very big impact on your valuation. And there's a very interesting debate out there that how do you define resiliency for an early stage startup? It's like, come on, I'm an MVP. What do you mean by resiliency? So there's an interesting debate in the market around that.
Yeah, interesting. No, I think you're right. You touched on, supply chain is very much more, much more top of mind right now than it was because of the supply chain shocks that we've seen. Certainly cybersecurity, what's going on there. I think this past week has been somewhat scary as it relates to that. What's going on with Twitter, what's going on with the reports of, hacking for the now vaccine development has become a big target for that. So cybersecurity has gone up. The remote workforce has put a whole new level on both cybersecurity and other tools that people are using. So you can see why those IT budgets haven't gotten slashed. And in fact, some of the large companies, if I'm not mistaken, the kind of the tale of two exits from my perspective has been that in life sciences, the IPO track has continued well along. So for therapeutics, medical devices, those IPOs are still going out. But on the digital technology side, it seems like some of the large companies, they've ramped up their acquisitions, right? I mean, Microsoft, Amazon, a number of them have come out with a pretty steady stream of acquisitions in the last 4 months. Are you seeing the same thing?
Absolutely, and I'm actually also seeing IPO paths for deep tech companies go through the roof, right? I remember, back in 07, 08, the word SPAC was a 4-letter word. Right now, SPACs are all the rage. In fact, very interesting, DraftKings, if you're aware, went IPO via SPAC. Palantir.
Okay, for our audience, can you define a SPAC, please?
Oh, that's a very, very long. So SPAC is essentially a public company with a lot of money in it, which acquires a private company to take it public. Okay. So if you're a private company that wants to do an IPO, what do? You do a direct listing, or you go through the usual IPO route, or you do a reverse listing through a SPAC. So SPAC are these shell companies, if it were. I don't know if I'm using a pejorative, don't mean to, but shell companies, as it were, that have that money and are looking to acquire large private companies in a much easier path towards an IPO. Yep. Right. So we're actually seeing a lot of that happening in technology right now. Right. And I don't know if there's a causality or a cause and effect here of M&As being ramped up as a result, but we're actually seeing paths to liquidation have not taken that much of a hit across the market. The only path that we've seen, and a flutter, I won't say a decrease or a collapse, flutter is the secondaries market, which have dipped quite a bit. But other paths to liquidation is what VCs really live for, right? You can invest in something, but you have to liquidate it at the end of the day. So there's an interesting play occurring there in the market.
Interesting. Yeah, I'm going to have to follow those. I think it's special purpose acquisition.
Something.
We both got stuck in this.
No, it's special purpose acquisition company. Yeah.
Company. There we go. Yeah. Got it. Perfect. All right. So let me go with kind of my last two questions, and then we'll take some of these questions that are queued up here. So you've spent And you know, I know you global perspective. You're here, but kind of look globally. But you're aware of what's going on here in Southern California and in Orange County. And so, with your time at UST Global, you guys 20 million to many hundreds of millions of dollars there. Now you're working at CerraCap. You know, what should the Orange County, Southern California technology sector try to do better? Where are some areas that as an ecosystem we should try to improve?
Right. So as I said, we were guilty of a bit of a myopic view where we've gone around, investing all over the globe, but not looking that much in our backyard. And we actually started making a way more concerted effort to do it. And the OC story I see, and whatever I say is more opinion because we're in the process of getting into it. But the more you look at it, the more amazing it is. I mean, Orange County has the money. It has success stories. You've seen some very large success stories come out of here, right? It has the brain power in the universities, another very, very critical angle seen when you look at an entrepreneurial ecosystem globally, right? But you still have Silicon Beach that gets all the credit. Right.
Yeah.
So there was an interesting aspect, an example of, should we call it the Silicon suburb, which I hate, by the way, just to go on record on that piece. But I think what would be awesome to see, and you guys have already laid the groundwork for that, is a tighter knit ecosystem around that, because the key ingredients are there. If you look at a lot of other places, they might have the money, but they don't have the success stories come out of there, et cetera, right? And frankly, in Orange County, we do live in paradise. So attracting people is not that hard, right? So which is the other aspect, attracting external talent. So tighter knit ecosystem internally, and I think we need to do a little more marketing in attracting the right external talent. But the key ingredients are here, and amazingly so.
Well, certainly, yeah, I believe that. One of the executives that I know used to say that from an Orange County technology company perspective, and I think a lot of this had to do with enterprise. There is a strong enterprise software DNA here in Orange County, maybe more so than up in LA and Santa Monica. Engineers that have built products for the enterprise. But the other part of it is that, I believe one of our strengths is that that there's certainly a little bit more stability. So, in engineers that you hire are less likely to kind of make the leap down here than they might in a different area from one to another. So that helps. Okay, last kind of general question. And this is kind of advice to any of our young audience members out there. So what advice would you give to the young audience members who would like to get into venture capital? You said it early on. Your path was incredibly kind of a random path. So what advice do you give, considering it seems like everyone's path is random?
My first and foremost advice would be, don't do it. No, I'm kidding. You'll actually make more money as an entrepreneur. But in today's world, and when you look at venture capital, you look at investing, you have to have the right blend of understanding startups and their operations from the inside, understanding the market from the outside, understanding technology and its evolution if you want to invest in technology, and finally understanding finance. No one person can do it all, right? And that's why you have to have the right team. So the advice I could possibly give is to focus on one of those areas and go really deep. Doing that, you will be a priceless investor, right? Because there are people who can look at all of those various aspects, but understanding one aspect deep, and of course, having an understanding of the other ones, is really the key aspect in terms of investment, at least in today's world. If you look at how venture capital was back in the 80s and 90s, which was mostly financially dominated, and it had to be, right? Yep. Versus how venture investing is today. There's a massive difference. But with that diversification, and the greater the diversification, the more the need for focus. So that's what it will be.
Good. All right, let's blast through some of these, and I'm going to ask Saurabh to give us really short answers so we could get to as many of them as we want. So, kind of right off the top, and in fact, you might have brought them up too. So, do you guys invest in IoT-focused supply chain and traceability
That seems a mouthful, but if it's IoT focused, probably depends on the platform.
Right, right.
Send me your deck.
We're going to get to that. So how about what success failure rates do you see in your seed rounds in getting to Series A? Great question.
Seed round to Series A. I mean, we've had a 95% hit rate from seed to Series A in the companies that we've hit from seed because of the ability to drive the revenue. But there are so many factors at play from a VC side, from an entrepreneur side, even more around that. There's some very interesting research from CB Insights and PitchBook, actually, not to give them a plug, but very interesting research on failure rates of startups that early. So they'll have a better answer.
Right, exactly. Good one. All right. Somebody, one of our listeners, Preetha, asked if you could quickly describe that CEO cross again. Just a quick description of it.
Revenue profitability, risk, and quality.
Got it. Okay, revenue, profitability, risk, quality. Got it there. Someone's saying interest in, they might not have been fully paying attention, interest in the biomedical space. Probably, why don't you describe from a data perspective, yes, right?
Yeah, but only if you're approaching it from a data perspective. If it's a pharma perspective, we can help you.
Right, right. Let's see. Oh, wow. This is an easy one. Is there a framework you use to shorten the sales cycle? Go rewatch the webinar next week and kind of go through all of that. I think we've covered a lot of that. So interesting. So, oh, interesting. Great question here. How do you safeguard your investment overseas when some governments have restricted access to development of software or the use of some software in their countries? And specifically, do you have any investments in China, and how do you safeguard that? Excellent question.
Right. No, we do not have investments in China. You need a completely different setup to enable those. And yes, before investing in companies globally, that's one of our key areas we look at is the ability for IP and IP transfer. Okay, because if you're going to go IPO in the US or even sell to certain companies, right? If you want to sell to some of the larger giants, it's actually a requirement for IP transfers and those things, or even when you go into an M&A kind of a situation. So we do have a framework internally of when we look at foreign investments, not just on the tax side, which would be financial, but on IP and talent transference as well. But that's an awesome question. And yeah, like I said, we don't go to China.
Right. Okay. Perfect. Perfect. Okay. Let me see. I think I have time for like maybe one or two more. Have you guys specifically looked at any COVID supply chain concepts?
COVID supply chain concepts, not as yet, no. We have looked at COVID solutions and population health data analytics, which we love. Again, the AI health data play around it, but not specifically around COVID supply chain.
Okay, perfect. All right, and I guess the last one, what's your take on DaaS and PaaS companies? I'm not even sure if I know what a DaaS or a PaaS company is, so maybe you'll both
platform as a service and data aggregation. Yes, but again, those are great buzzwords. There are very few companies that we've seen that can actually monetize something out of it. I love the data aggregation play. There's that awesome example of data has overtaken oil as the most valuable commodity in the world right now.
Right.
So love those data aggregation plays. The question is, what do you do with it and what's the outcome? I look at your business model or your go-to-market later, the DaaS, PaaS, SaaS.
Right. Okay. Well, I think that's a great place probably to kind of wrap things up right there. I definitely want to thank you, Saurabh. This has been terrific, a great conversation. We, and I'm sure all the audience, appreciate your knowledge and insights. And I'm so glad that you were able to share them with us. The other thing that you were generous enough to share with us was your email address, which is on the screen right now. So please, folks, be kind, be polite, be patient if you're going to email Saurabh anything. And but we really appreciate him doing that. So we'd also like to thank again Kenobi Martins, our VC Speaker Series sponsor. at Kenobi, where you'll find a unique intersection of technical intelligence and legal acumen for a world powered by innovation. Another the great marketing blurb. And I'd also like to thank, I haven't done this before, but I would definitely want to give a shout out to Travis Rubido. He's our producer behind the scenes. He makes a lot of this possible and frankly, quite seamless. So I appreciate Travis doing all of that. And speaking of which, Travis, I think, can you put that, the registration link for next week's webinar will be in the chat box right now. So you can click on that and register right away. And a recording of this will be available on Monday. So if you go to our website, innovation.uci.edu, and click on events, you will be taken to a page where you can see recordings of all of our, except one, all of our webinars that we've done so far. So I think with that, Saurabh, thanks again. We appreciate it very much. Thank you for everything you're doing for the ecosystem. And if there's anything we can do, we're at your service.
Perfect, Luis. Thank you so much for your time.
Okay, everyone, thanks for watching. Be safe and be healthy out there. Thanks so much.
Thank you. Goodbye.